Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Danielle Park is president and portfolio manager of Venable Park Investment Counsel. She wrote the best-selling book, Juggling Dynamite. You can find her blog at jugglingdynamite.com. And it's always good to have her back on This Week in Money. Hey, Danielle.
Hey, Phil. My pleasure.
Theme this week seems to be economic data, big thumbs up there, and corporate results, big thumbs down there. We're hearing a lot of corporate earnings, and that's basically making the market move sideways this week.
Yes, well, it's been one after another. 63% of companies that have reported so far for Q3 have missed their revenue targets, which I think is revealing. It speaks to this shift in global demand that we've been talking about for the last few months. DuPont, Dow Chemical, Colgate, Xerox, Caterpillar, all these big companies are saying that they see a much lower demand picture as they look out into Q4 and into 2013. And, that's irrespective of whether there's a fiscal cliff in the U.S. Mm-hmm. They're just saying right now, today, we're seeing that there's a lot less demand in the world. And they're responding in their typical way, of course, which makes sense. They're trying to manage their margins, Phil. So what they do is they announce thousands of job cuts. So this is where I'm concerned about the next phase of the economic cycle, because as we've mentioned, you're coming into this downsize again already with elevated unemployment levels, and already, particularly in Canada, very elevated consumer debt levels. So you couple those two together and you start losing a few thousand jobs here and there as you go into the next 6 months, and that becomes quite a weak point.
I guess the real surprise with earnings, of course, is that the bar is normally set so low to start off with.
Yes, well, because they do this whole charade of downsizing expectations as you head into it. But that's where it becomes quite amazing that you've had such a low beat level because they already have massaged down expectations, and then you're still getting a high percentage relative to historical averages of companies that are missing their own lowered targets. And that's where you realize that some of the things that are evolving presently in the global economy are coming as a bit of a surprise to those multinationals. Mm-hmm. And I think it's this whole business of, the low rate environment that's been engendered by the central bankers over the past number of years, all with the idea of stimulating demand on credit. What they're missing is that now you have that part of the population that is prone to borrowed to the roof, trying to manage their payments even with really low rates. They're having a hard time because they're not getting real wage growth, so they're not able to increase their spending. They're just trying to service their debt. And more importantly, the bulk of the wealth, Phil, is in this baby boomer cohort. Let's talk about, the percentage of the population which is in that 45 and plus category. In the United States, that's about 40% of the population. We know that they actually have the bulk of the savings or equity, such as it is in the economy. They're the ones who have it.
Sure.
The problem is they also have whatever savings is available in the economy, and they are suffering because rates have been pushed to nothing. So their ability to spend is dramatically impacted. They're not spending at the levels they were. They're worried about the future because they're looking at their own life cycle and saying, gee, I'm already getting to the end of my working years and I hardly have enough money saved. In fact, most have very little saved.
Sure.
But relative to the people behind them, Phil, relative to the younger generation, they are still so much better off. And there's only 23 million people born, for example, in the United States that are born since 1995. Well, they don't have money per se, and they aren't able to pick up where the boomers are easing back. So you've got this U.S. government and the Federal Reserve has spent, for example, almost $8 trillion over the past 5 years, Phil, to try and ignite this demand in the economy. And they've done most of that on credit, by the way, which creates its own drag on the economy. And they've been trying to resuscitate this demand cycle, which is demographically impossible. Mm-hmm. And I think that's why you've got, since they brought out QE Eternity and all the other policies announced around the world to try and keep stimulating, the world is realizing we're at the end of that cycle. That is no longer having the desired impact. And that's, I think, why the stock market has been trading down basically since that announcement came out in September.
Speaking of the Fed, Danielle, no change. That's the word this week from the FOMC. Those are the folks who gave us all that wonderful QE. They're deciding to keep rates low and they're going to buy more bonds that, of course, they hope will hold down long-term interest rates.
Yeah, well, they don't really have anything left to add. And I think that perhaps they did that because they were tired of being, the magicians called in to pull out the next rabbit. And so they basically said, here's what we're going to do. We're going to keep doing more of the same as much as we can and keep it up as long as possible. But again, when we look at the impact that's having on the real world, on the real economy, the fact that they've only ignited some commodity inflation but no revival in wage growth, no revival in actual demand, you realize you're at the end of that rope. And so there's no other magic hits that we can look to. The other thing I think is really important here for the equity market and for commodities to a large extent, because you have a lot of people investing in commodities as a fixed asset class today. But really, as we look into Q4 here, Phil, you've got, let's recap the year. We had a equity market that was negative into the summer, right, for 2012. Whatever gains have been available in the equity market have basically been made, in the third quarter when Mr. Draghi and the central bankers announced that they'd try and stimulate some more. So you had this pop. So now, if you're sitting on any capital gains for the year and you're a traditional money manager or a hedge fund manager, you've had a rough go the last few years. You want to show some positive gains. So I think there's an impetus to the professional managers to try and capture some gains that they made in the past few months, this quarter. Also, if you're an individual investor, you're looking at the capital gain rate, potential capital gain rate change that's scheduled for 2013, and you're thinking, gee, I could sell now and for sure pay that low 15% rate on my capital gains. So I think that's why there's selling pressure for stocks as we move into, and the last thing, of course, is just so much uncertainty about the election. I mean, what if they get a hung verdict again, Phil, and then we got the debt ceiling coming back? What if it takes them weeks to resolve who won this next election? It's quite a poop show.
We have some good economic news this week. Durable goods orders in the U.S. climbing 10% last month. Get this, the biggest gain in more than 2.5 years. That's after they fell by the largest amount of in 3 years in August. It's getting hard to make some sense out of all this data here.
Well, it is always complex, and that's why I like to pull back and get the 40,000 foot view, from top down, because what you see is that, that's a very volatile durable goods has been a very volatile series over the last several months. If you take out, non-defense like transports and that sort of thing, you see that it was just up 2%. And I think what's really important here is that we see this anemic capital expenditures. So this is companies that are not spending much in terms of investment and in terms of buying equipment and that sort of thing. I think there's a few reasons for that. One is because they're concerned about the economic demand that's out there, and they're looking forward and saying, gee, I don't see a big revival in 2013. That's the first thing. I think the second thing is the low rate environment. Back to this. There's huge pressure on companies to try and increase their dividends, right? Because everybody is desperate for cash flow,
sure,
and they haven't been able to deliver big capital gains in their stocks. So they're saying, we'll increase the cash flow that we're paying our investors. So what does that actually mean, Phil? It means that companies have less cash in the coffers to do things like capital spending. And so I think that's also a factor that's slowing the momentum and growth in the economy, is that there's not just uncertainty on the political front, not just on the economic demand front, but also just an urgency to try and give back more cash means that companies are feeling a little more frugal with the cash that they have.
We are talking to Danielle Park from JugglingDynamite.com here on This Week in Money, and over the blog, you're highlighting this PBS Frontline show, Climate of Doubt. I should mention to our podcast friends, at the time we are talking now, the link doesn't work. The PBS folks are working on it. But interesting that neither Romney nor Obama talking much about climate change in the debates.
Yes, and I think it's because of the reasons that are explained in the PBS documentary that there has been this sort of resurgence of effort on the skeptic side to raise this whole question of whether or not climate change is actually being impacted by humans. It goes in phases, right? There was a couple of years ago, there was a consensus of something like 98% of the scientists surveyed said they believed that climate change was true, was happening, and that humans were having some impact. But there was a couple of percent who, could throw doubt on that or say that they didn't think it was the case. So now you've had a lot of focus on trying to upset that again and call back into question. So I think a lot of politicians have been pulling back saying, geez, well, maybe I was wrong to agree, like John McCain and these people who said we agree that, finally, even though we're Republicans, we agree that humans seem to be having an impact. Now they're sort of recanting from that. So I think politicians in general are loath to commit to a strong position on that. And you know what? I understand that. I think that, being not a scientist and hearing, some very vocal critics saying it's not true, we're not having an impact. If you ask me my intuition based on what I see, I would think that humans are making climate change worse. But more importantly, Phil, who cares if we're making climate change worse? Let's look at, does it make sense to continue degrading our natural environment as we are living in a place where water supplies are being compromised, where air is becoming more and more polluted, where, impacts on our health and toxicity in our environment is escalating? Why wouldn't we try and fix that in intelligent ways rather than waste all our energy about whether or not climate change is in fact happening? Let's bring it back to a much more selfish level, which is our own environment is being degraded, and we can prove that in many ways, regardless of whether climate change is happening. And I think that's where the level of discussion needs to go, so that we don't waste our time on, existential questions that perhaps the individual can never really solve.
Why are the candidates not talking about it?
Because I think they're afraid that there's no clear answer there, and also I think that in the midst of the economic crisis we find ourselves in, very few people feel we can afford any serious measures with respect to environmental protection. That's part of the budgets that are being slashed left and right in Canada as well, Phil. There's a lot of programs which are now losing funding on the environmental protection side. So I think they just think it's not popular because, first of all, there's this renewed phase of questioning and doubt over the science of the matter, not in the majority but in a fringe group. So they're afraid to be wrong in their statements. And secondly, with so many people out of work and trying to literally feed themselves, they feel that it's not a palatable discussion to be talking about the environment. Where, the sad part is that in the boom phases, we never think it's appropriate to be talking about the environment either, right? So humans are just notoriously hopeless at getting around to things like health. And I think that as I say, as we go along here, I hope that we marry the need for economic growth behind this ideology or this movement towards better health, which means that we can, create jobs and have industry come in with innovation and technology to help us solve some of the things that are going wrong in our environment, and we don't have to drive it from the issue of whether or not there's climate change.
Danielle Park is president and portfolio manager of Venable Park Investment Council. She wrote the best-selling book, Juggling Dynamite, and you can find her always interesting blog at jugglingdynamite.com. Hey, thank you, Danielle.
Thank you, Phil.
This Week in Money is archived online at talkdigitalnetwork.com.
Sean Brodrick is editor of Red Hot Global Resources and Global Resource Hunter from Weiss Research. You can check out Sean's blog at uncommonwisdomdaily.com. It is always good to have you back, Sean, here on This Week in Money.
Thanks very much for having me on again.
You're just back from the World Money Show in Toronto. What was going on there? You were talking about the bull, the bear, and the ugly in precious metals. How'd that go?
Basically, I talked about how October is usually an ugly month for gold, and it is. We've seen a correction of over 5% from the high to the low, which was just under 1,700. Now, it could go lower from here, but probably not much lower. And then November is usually a great month for gold. So, I've just made my shopping list. I actually added one position yesterday, and I'll be adding more soon, I think.
Big news in your part of the world. Of course, 2 weeks to go in what could be one of the closest presidential elections in U.S. history. And, of course, everybody's trying to figure out which way it's going to happen, who's going to win on November 6th, and how that's going to help us invest next year. You and your colleague Tony Sagami am I pronouncing Tony's name right?
We usually say Sagami,
Tony
but
Sagami.
I'm sure he wouldn't mind just as long as you're dropping his name, because
exactly.
Any publicity is good.
So tell me a little bit about of this report that you and Tony put together.
Well, actually, it's two reports. He worked up one on the stocks that he thought would do extremely well if Romney wins, and I worked up one on what I thought would do well if Obama wins re-election.
Okay.
And so we have two reports ready to go, constantly updating them. In fact, I just had to update mine yesterday. But when we release them, which will be right after the election, we'll either have one or the other, depending on who wins, of course, and just with our picks for the stocks that should do the best because of who's in the Oval Office.
Now let's talk about the guy that you are talking about, and you're not necessarily predicting a win here. We're trying to be apolitical. If Obama wins, a couple of areas that you think are going to benefit most, starting with real estate.
Yeah, well, real estate is one. Certainly home builders and stuff like that should do pretty well. Now, they are improving already. That's basically because of, along with the fact that President Obama is trying to get people out from under the big mortgage debt overhangs, we have the Fed keeping rates as low as possible, and so that's a productive environment for getting new homes built and stuff like that. Also, having old homes sold, which is the important thing. People who are under these overhangs of like mortgage debt have a way out. So that's one thing that could really work out for those stocks. Also ones like Home Depot, for example, which is also doing well already because of the action taken by the Fed and by President Obama so far.
We're talking to Sean Brodrick from uncommonwisdomdaily.com here on This Week in Money. And the second area you're pointing out that would improve under an Obama administration, labor. How would that work?
We are seeing unemployment start to go down, not down nearly as much as anyone would like, but the movement is in the right direction. So that makes job agencies like, say, Manpower, for example, those can do extremely well. And so those are ones you would look to in an employment recovery.
Okay, so the report's called Election Day Survival and Prosperity Guide. Sounds like a good deal. How can we get a hold of it?
Well, I believe they have links right on the website, and I should add that these stocks we've just talked about are actually not picks in the report. I actually have other stocks I think will do even better, and so I have 13 picks, which is 9 stocks and 4 funds, that I have on my report, and I believe Tony has 12, though I can't remember exactly because he wrote his report, I wrote mine. But so he has picks he thinks will do well if Romney wins the presidency. So it can go either way. Frankly, I believe that people are so sick of this election, they'll just be glad when it's over, and they'll be glad to be able to get on with their lives and have some clear idea of what the policies will be going forward. I believe that's one of the things weighing on the market right now is, businesses don't want to invest money because they're not sure if the policies will be in place to support their decisions. So they want some clear vision of how things will go. Once they have that, then they're more likely to open up the purse strings and actually start to spend money again. We have seen U.S. consumers spend. In fact, that gave GDP a nice lift in the most recent quarter. It was up to 2% growth, which is more than the 1.8% that economists were looking for. That was basically on the backs of the consumers, and also consumer sentiment improved to like multi-year levels at the same time. So the consumers feel okay, but the big corporations are just pulling in their horns because I believe they have uncertainty about the future, and some of that uncertainty could be answered by the election.
Sean, last week you took a closer look at 5 Obama goals that would boost the economy, and we're talking about how to make some money out of all this. Let's talk about goal number 1. He wants to cut oil imports in half in the next 8 years.
Yeah, well, he wants to. It'll probably happen anyway, no matter who's in the office.
Okay.
And that's one of the funny things out there is you have Governor Romney laying into President Obama about high prices at the pump, and then you have President Obama saying, well, actually we have higher oil production and all this stuff. It's all happening really despite what they're doing. I mean, not so much like either of them would stand in the way, but it happens anyway. It's part of the global supply-demand picture, and new technology has made these like whole fields in the U.S. much more accessible. You have the Bakken and things like that, and we are just seeing much more oil come out of there. I believe it's a real game changer. In fact, I wrote about that for both my Red Hot Global Resources and my Global Resource Hunter publications about the game changer in oil. And I believe there are companies that can do extremely well. Many of them are exporters, though, also transportation companies, refiners, those that are exporting their products. And some producers can do well, but they have to be able to get their oil to where they can sell it. That's the thing. I mean, because right now, the main oil depot in the U.S. is just swamped with oil. They have a lot of it, and that's pushing down the price of the U.S. crude oil benchmark compared to international benchmarks, and that's also pushing down the price of the oil we get from Canada. That's at a huge discount to, say, the international benchmarks, and we're probably going to see more of that because there's all these oil rigs out there drilling. There's more production coming online. I think it'll be self-correcting eventually, but right now it's just a huge amount coming on. So back to your original point, yes, we are going to see tremendous production in oil production, and I think it'll be easy for President Obama to hit his goal, whether he does anything new or not.
Okay. Let's talk about goal number 2, cutting the growth of college tuition. How is that an investing area that we should be interested in?
Well, there are different ways to invest in that. Certainly it's good news for the private education companies that are out there, but it's also good news for students as well. And we have seen tremendous inflation in the cost of education in the United States, not so much up in Canada, of course, but here in the U.S. it's a real problem. And so Obama's trying to address that, and if he continues along that path, then we'll see more people getting educations, and so that's good for the private education companies.
How about this goal number 3? Is this realistic, 600,000 jobs in natural gas development?
It's hard to say. Yeah. Certainly there's a lot of jobs in natural gas development. Whether it's 600,000 or not, I don't really know. But there will be plenty more, and again, that kind of happens whether President Obama does anything or not. Now, he is talking about new credits for energy companies that are actually producing here in the U.S. That's a whole different thing. He just released a 25-point plan, which I'm speaking about in this report. And so you can see how he is trying to push more jobs in the energy sector and stuff like that. So certainly it's a worthy goal, and he could do it. A lot depends more on the price for natural gas around the world than what he's doing, but certainly he is going to try and push that along, so good for him.
You can get more information on Sean and Tony's reports at uncommonwisdomdaily.com. And from Sean's Twitter feed, at Sean Brodrick, here's a scary story that, as you mentioned, has been ignored by the mainstream media. I guess they're kind of bored with it now, but here's news out of Japan, the Fukushima Daiichi nuclear power facility. Remember the big problem they had there after the tsunami? The ground under unit number 4 is sinking, and that is bad news.
It is bad news because of how much nuclear material is actually stored on that site. And so that's the scary thing, because if it cracks the containment facility there, that could spew nuclear material, into the air, which would be carried around the world. So this is one of the things that's being ignored by the media. I think because there isn't any easy solution right now. One thing they could do is move some material out of that area to other places, and I think that's probably the approach they'll take. Whether they take it right now, working on it steadily, or else all in one big rush when something goes wrong, who knows. One more thing that I should add is we're starting to receive reports out of Alaska that there's large mammals with open sores up there. The salmon don't seem to be running. There's a shortage of clams where you would expect to find clams. These are things you would expect to see if radiation was spreading across from Japan to Alaska. Now, maybe some could have been carried by the tsunami. Maybe it's just a drift of things that have been happening since then. Maybe it's something else just completely, and it doesn't have anything to do with what happened over in Japan, but it's enough of a warning sign that people really need to be worried about that, and there should be a lot more investigation into it, because if what happened in Japan is starting to affect Alaska, well, that's just one domino you really don't want to see fall.
Developing story, and we should keep an eye on that. Also with energy, a strange story from Eastern Europe, wind causing a problem in Eastern Europe. Yeah,
too much of a good thing, because Germany has so much installed wind power now that when the wind starts blowing, it actually likes to push extra electricity to the other grids around it that it's hooked up to. Many of them are in Eastern Europe. They really aren't up to date. They're old. And so all that electricity surging along there knocks those grids offline. So people in Eastern Europe have blackouts because Germany has too much wind. And so that's just an example of too much of a good thing. I think they'll probably solve it with some kind of storage system. They could use molten salt. They could do a number of different ways to actually do it, but it's a problem they have to work on. That's one of the problems that they have in Germany is they've had all of this, alternative energy being developed. Now they actually have a lot of it, and so it can overload things sometimes.
We have one final story that you're watching on your Twitter feed. Jeff Clark, our friend at Casey Research, spotting a new trend in gold. Investors shifting from paper to physical gold. What's going on here?
Well, that's what he says. And I admire Jeff a lot. And so if that's what his numbers show him, fine. I will point out that also today, because his whole story, which I linked to on my Twitter feed, is about how people are now taking money out of ETFs and just buying physical gold and physical silver, and that could be happening. However, I would point out that we just had news out of Bloomberg, which is also linked to on my Twitter feed, which is obviously the happening spot, but also linked to it that the amount of gold held by exchange-traded products has just hit an all-time record. So I can't really reconcile those two stories. Perhaps just some further explanation is really needed. But obviously gold's becoming more popular with the investment class. In the U.S., people buying coins and stuff, not so much. It's actually down about 41% year over year. However, internationally, like the Australian Mint, they've sold out of some gold and silver coins just because those are really popular right now. And we are moving into the season over in India where people traditionally tend to buy lots of gold. So I think we're at a good time for gold. November is historically a good time of year for gold just on a seasonal basis because of all of the things going on in Asia and stuff like that. And then finally leading back all the way to Christmas, so it's November, December, really good times for gold. So if we just follow the normal historical patterns, then we should see gold head higher from here, or if not from here, then it's not going too much lower. We just saw gold dip below $1,700. That was snapped up pretty darn quick. That shows you the appetite for gold is there. And so, like I said, I just added a new position yesterday. I'll be looking to add new gold and silver positions soon. I think that we are at a good point in the market where you can start to put on the positions that you've held off putting on for quite some time, or at least if you've been listening to me, you haven't put any on in weeks. Well, we're actually getting to the point where we might want to start putting some money to work.
Sean Brodrick, editor of Red Hot Global Resources and Global Resource Hunter. Check out Sean's blog at uncommonwisdomdaily.com. And don't forget you can find Sean on Twitter, just like almost 1,600 folks have, at Sean Brodrick. Hey, Sean, stay safe, my friend.
Thank you very much, Phil.
This Week in Money is archived online at talkdigitalnetwork.com.
David Smith is a precious metals analyst, and he's a frequent contributor to the Morgan Report at silver-investor.com. Hey, David, it's good to have you back on This Week in Money.
Great to be back, Phil. How's everything going for you?
Everything's going fine. You are at the 10th Annual Silver Summit in Spokane, the heart of Morgan country, all things silver. A lot of folks, analysts, newsletter writers, explorers, producers, and the coin and jewelry guys are there as well. Just finished off the keynote from David Morgan, a brief history of paper money, and obviously paper money's falling out of favor, and folks are moving towards precious metals. What's the mood at the Silver Summit this year?
Very positive, very intense, and the people that come here are a special breed. They really take their work seriously. And so David's speech, I have to say, I've heard many of his speeches. This is the best he's ever given. It was really, really good.
We also had an interesting guy, Bix Weir. I've never heard of him before. He talked about the mechanics of silver price manipulation. That must have been interesting.
Well, he's talked about things that some of us know a lot about and some don't know too much about, but all the issues of the short selling that goes on, the leasing of gold and silver, especially primarily gold by the central banks, and the lack of transparency sometimes about how much supply is out there. Not to mention the debasement of our currencies by the central banks. And this is becoming a bigger and bigger issue, and it's leading toward a loss of confidence on the part of the populace.
We're talking to David Smith on This Week in Money. We've seen a pretty good rally this week with silver and with gold. Silver climbing to over $32 again. How's that playing at the summit?
Well, today I checked the prices about an hour ago, and it's pretty quiet out there. But people that come here take a little bit longer view. They want to see, they want to talk to the companies, and they want to see if their portfolio is the way they want it with the selections they've chosen, and they want to listen to forward-thinking people as to where prices may be going, and they know that nobody can predict prices, but the trend is certainly still up. And what's really gone on lately, too, is a tremendous move from actually buying paper like ETFs to buying the physical. So the physical demand is just continuing to be stronger and stronger. Greg McCoach spoke here this morning, and he has his Amerigold operation that sells bullion, and he says he's selling a more dollar amount of silver than he is gold. And when you consider that the ratio is, I think, 35 or 40 to 1 right now, in other words, that ratio of silver in relationship to gold to 1 ounce, that's amazing because people are buying, they're not buying the ratio, they're buying 1 to 1 in terms of the dollars that they're investing in gold versus silver.
All of this playing against kind of a mixed bag of U.S. economic data this week, David. Good news, the GDP for the third quarter, a little higher than expected at 2%. And bad news, the consumer sentiment readings lower than forecast. And that's got to obviously affect gold and silver.
I think so. And, of course, that these all these figures that the government puts out are continually revised a week or a month later. And we're in the silly season for the presidential election, which is going to occur here pretty darn soon. So, you can keep an eye on those statistics, but you look at the big trend and see where it's going, and there are an awful lot of things that are pointing toward real serious systemic issues that really neither party has even begun to resolve. And so people really need to ask themselves, if I don't have a position, shouldn't I be taking one? And if I have a position, do I have enough?
Here's kind of a troubling number. During the month of October, David, gold decreased in price by 3%, silver down 7%. Is that just a temporary setback, you think? What's the outlook for silver?
I think so. And when prices are flat to weak, the news is negative. And when the price is stronger, the news is positive. So there's an old saying that if it's in the price, if it's in the market, it's in the price. Or if it's in the news, it's in the price. I guess that's how it goes. People just have to keep their eye on the bigger picture, and I think the great danger is if your picture is too small rather than too large.
Yeah, I guess one thing we got to keep thinking about is quantitative easing and how that affects precious metals. Here's some interesting stats for Fed heads in our podcast audience. Silver during QE1 rose 53%. That's twice as much as gold. During QE2, it rose 24%. That's 3 times as much as gold. And here we are just starting QE3. You think that kind of trend is going to continue with silver?
I would expect it would. And the thing is, there's a lag effect between the time that these announcements are made and the money gets in and circulation takes effect. And I think that new burst of money, which is now being printed and will be continued to be printed as long as the Fed feels that inflation isn't where they want it to be, because they fear deflation above all else. I think that's going to work its way through the system like a large meal that a python is eating, slowly working its way from head to tail.
David Smith, our guest on This Week in Money, and let's look forward to what's going on in the silver market in the next little while. Here's an interesting stat from China, the world's second largest silver user. Demand there going to go up maybe as much as 10% next year. That will also drive silver prices higher, I'm thinking.
Very definitely. And, the demands from China and India in terms of investment, in addition to the normal holdings for jewelry, this is a factor that's just massive compared to the bull market we had in 1979 and 80. Mm-hmm. And I think people really need to notice that this is a global phenomenon now, not only with demand, but also with the reflation by the major countries across the board. And so this is going to be much, much larger in terms of its effect and where the prices eventually go over the next few years than what we saw in 1980. And I think we could end up at highly elevated levels on gold and silver and mining shares for a long time to come.
Another prediction here from Morgan Stanley. They're saying silver probably will beat gold in the next several quarters. You think that's true?
I think that has a high probability of being the case, because the gold-silver ratio is still on the low sides for silver in relationship to its greater volatility. And there is a 92% correlation, according to Adam Hamilton, as to the gold price moving and the silver price moving. In other words, they're pretty close to lockstep. Not always on a day-to-day basis, but over a certain period of time. And so the thing is, with silver, its volatility is much greater than gold. It's ups and down swings, and this is what gives investors heartburn. But once they recognize that's just part of silver's nature, and then work to accord with that so that they are in accord with the nature of silver, they can become much more relaxed.
David Smith, our guest on This Week in Money. He's at the Silver Summit in Spokane, and we're talking naturally about silver. And let's talk about the miners for a second. Shares of some of the big silver companies up. Silver stocks increased 12 of the last 20 days, so it's looking pretty shiny out there.
Yes, it really is. And, David Morgan called the bottom on those several months ago, and they have really performed well. And as Frank Holmes pointed out and others, that these mining shares are trading at around the two standard deviations from the norm in relationship to where they should be with the metals price. And two standard deviations mean 98% of the time things don't trade that way. So there's a high probability that over the coming months that we're going to see this deviation close back to something according to normality. So a quality mining stock or a quality ETF with the miners in it should do very, very well, even if the metals price itself doesn't explode upward right away.
Brings me to my next question, Dave. In the context of what's going on here, how can we make some money? What are the investment opportunities presenting themselves in bullion and in mining stocks?
Well, I'll tell you, I think in bullion, people need to continue adding on a dollar cost averaging basis if that's what they want to do, or as money becomes available. In terms of the mining stocks, and I'm going to do this myself this weekend, I'm going to go through and look at my portfolio and really ask myself on each case, do I want this stock? Do I want to add to it? Do I want to take some out? Because I think we're going to see a winnowing process, which is really not fully recognized by the market yet, where the weak hands are either going to be taken over by stronger ones, or the wind will simply blow them away, because financing is so difficult now. And some of these projects, if they don't have a great project and they're not close to having something significant happen, and they can't get the money, they're just not going to be a contender. So you want to bet on the strongest horses, whether that's in the producer space or the exploration space. And if there's something that you doubt, even if you're down 50, 60, 70%, maybe you should take that money and put it on the strong horse, because odds are you'll be able to recoup that pretty quickly, whereas your other weak horse may simply collapse at the side of the road and you'll lose everything. And I'm doing this on some of mine, so I'm taking my own medicine.
Are we looking, Dave, at the same kind of trends that have been happening all year, that trend toward more mergers and acquisitions in the gold and silver space?
I do think that will be the case, and unfortunately for some of the companies and shareholders, some of these mergers are going to be at fire sale prices. So you could have been right on the story, but wrong on where it gets merged. But I also think an even greater threat is that some of these companies will simply be dead in the water. And so you, as a shareholder, may find your company delisted, or you may find no volume so that you can't get out. So you really, I think, need to look at what you have and say, are the reasons that I bought this company still valid? Do I still believe in it? Do I still believe management can and will do the right thing? And if you don't believe that any longer, well, then maybe it's time that you part company with that choice.
Always good to look at what's happening in the ETF world. The GDX and the GDXJ both having a pretty nice time. What's happening with ETFs these days?
Well, ETFs, of course, I wrote a report for David Morgan a couple of years ago, and it was called ETFs Silver Bullet or Double-Edged Sword. And the reality is that they are all double-edged swords in that, especially the leveraged ones, because some of these leveraged ones, like the silver ETF USLV, is a 3X. In other words, it moves up or down 3 times as fast as silver.
Yeah.
And you have leveraged mining stocks like Nugget and UGT. These can be very powerful additions, carefully added to your portfolio, but they can cause you some real grief if you're on the wrong side of the move. But I think ETFs have a very important role to play within the context of being careful of what you're doing and understanding the specific ETF, and ask yourself, is it performing the way I want it to, and it's in terms of being cost effective as well? And if you use them carefully, like you would put your hand on a hot stove, I think you'll be all right. You won't get burned too bad.
David Smith, our guest here on This Week in Money, and you're at the Silver Summit in Spokane. One of the things we don't often touch on because we're so busy talking about the gold and silver price is coin dealers and jewelry dealers. There's a lot of coin dealers at the show. What's the general kind of feeling among those guys?
Well, they're optimistic about coin sales, and of course, numismatics is an area that you have to be so careful with. And I own a few numismatics coins, but I'm just not very knowledgeable about the buying and selling of them and making sure the grade is right. And I know if you get a good person that is honest with you, you'll be okay. But, really, for most of us, including me, really, for the most part, if you want to hold the physical, you should be buying bullion coins or bullion rounds. Maybe buying the, Canadian Maple Leafs for sure, or something like the American Eagles, because they carry a premium that's not too bad. But you shouldn't be paying 2 or 3 times the price of the metal for what you're getting. I mean, if you buy the Maple Leafs or you buy the American Eagles, you'll pay $3 or $4 over spot. That's fine. But you shouldn't be paying 10, 15, 20 over spot, because that you lose that when you walk out the door. So be very careful and try to get as close to the spot price as you can when you are buying your metals.
David, less than a couple of weeks to go to the U.S. presidential election. A lot of folks saying it's too close to call. Is that affecting silver and gold prices at all?
I'm sure it is, and probably in a significant way. I don't know anyone that can quantify it, but I heard an interesting quote the other day, which is kind of humorous, and it probably won't offend anybody on either side of the political fence. And I consider myself an independent thinker, by the way, rather than a Republican or Democrat.
Okay. But
the saying goes that if Obama wins, gold and silver will go up. And if Romney wins, silver will go up. So silver meaning, it's industrial metal use. So I think that's pretty cute. But really what it says, and that doesn't even address the systemic debt issues that we have that somebody's going to have to deal with, hopefully within the first 6 months of the new administration, whether it's a repeat of the old one or a new person. If those aren't dealt with in some way that starts to change the trajectory, it's going to be bad news ahead for people down the line. So either way, the precious metals are going to be winners. It's just a question of how much and when it happens.
Yeah, I was just going to say, no matter who wins the election, the underlying economic issues aren't going to go away, and they appear to be balanced in favor of precious metals and away from paper money.
They are firmly entrenched, and we have certain trajectories that go to the point where there is no return, and it's just a question of how it's going to play out and how much grief it's going to be. And I think we'll have a new day eventually where it'll be an opportunity for all of us to be in a much more relaxed space. But for now, a person has to be alert and proactive and be willing to take action on their belief, on their core beliefs, and where they think things are headed.
David Smith, our guest. He's a precious metals analyst and frequent contributor to the Morgan Report at silver-investor.com. He joined us today from Spokane and the Silver Summit. Hey, Dave, thanks for talking to us.
Okay, Phil, have a good one. We'll talk to you again.
Thanks to our guests, Danielle Park, Sean Brodrick, and David Smith. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.